What's up, everybody? My name is Joe Brown, and this is Heresy Financial. On Friday morning, Federal Reserve Chairman Jerome Powell gave his speech at Jackson Hole. In this speech, he signaled quite clearly the future path for the Federal Reserve, their monetary policy, and what they're going to be doing with their asset purchases and interest rates. So today in this video, we are going to talk about, number one, what Jerome Powell said, number two, what it means for the future of monetary policy by the Federal Reserve, and number three, why it sent markets sky high. Ready? Let's dive in. It's important to note here that every single word from these pre-scripted speeches that Federal Reserve members give are designed, the intent behind them is to move markets. 110% the goal of these speeches is to try and enact monetary policy and make changes happen in the economy based on expectations about monetary policy so that they have to do as little as possible with actually changing things about their monetary policy. They want to try and change the markets through expectations alone. So the first thing that he addressed that stood out to me was he talked about inflation. He said, basically, inflation, there are some readings of inflation that are a cause for concern, but we still hold to the belief that it is going to be transitory, going to be temporary. And I've said this before, I'll say it again, when they're talking about inflation and they're saying that it's transitory or that it'll go away, they mean the rate of change of prices. They don't mean the absolute level of prices. That means if inflation is 5% right now, they expect inflation in the future to be, let's say, 2%. That means that the big increase in prices we're experiencing right now, they do not expect that those prices will come back down. They're just expecting that the rate of change in those prices will slow again, so that we're experiencing a big jump in prices right now, and then the rate of change in prices will level off. So those prices aren't coming back down, they'll stay up where they're at, and they'll continue to just grow a little bit from there. Now, the other thing that he said about inflation that I thought was kind of funny was that he said, we're looking at all sorts of measures on inflation. And he says, because we're looking at all sorts of measures of inflation, we can see that these spikes in inflation aren't broad-based. And so basically, there's not really a cause for concern because it's not across the entire, every single measure of inflation we're looking at. It's just in isolated areas that we're seeing the big spikes. Basically, what he means by that is we have so many different ways that we use to measure inflation. We can smush around the data to make the official numbers look like your cost of living isn't actually going up as much as your grocery bill or your budget says it is. Par for the course. Now he says the other thing that they're looking at is they're looking for a rise in wages because he recognized in this speech earlier on that wages rising are necessary for an increase in the quality of living. Now here's the thing, that is only necessary if you've created a system that is built on inflation, a system that can only survive if all prices always go up. Because for most of human history, you have deflation, where over time, people get more for less. You bring abundance out of scarcity. Through technology and progress and wealth growth, basically what happens is over time, people's cost of living goes down. This means that just by saving money with a zero interest rate, you save money. Next year, you put $100 away this year, next year that $100 will go further than it does this year. That means you don't need a raise, you just get your same salary and now you're richer this year because things got cheaper. So not only can you save more, but every dollar you save gains in purchasing power over time. And this is a natural byproduct of an economy or a system built on sound money with a non-elastic supply. But instead, we've got a hamster wheel economy where you have to increase the supply of money exponentially to keep pace to push asset prices higher. And then you're in a situation where you need wages to continually rise in order to just keep pace with the cost of living. The problem is this is not how new money moves throughout an economy. Typically, when you have new money enter an economy, you have it first hit asset prices. So basically the rich get richer, then it hits the prices of goods and services, that hits, consumer inflation, and then after that, usually you see it hit wages. So by the time people get their hands, the average person gets their hands on that new money in the form of raises and increased incomes, the cost of living for them has already gone up and they've already been hurt by it. And the funny thing is that exact same course of progression of new money happens with deflation as well. And so when you have deflation, typically asset prices get hit, then goods and services get hit, and then wages get hit. And so when you have a deflationary system over a decades long period like we had from, let's say, 1870 to 1900 in the United States, even though people's nominal wages went down, their cost of living went down even further, which meant their real wages, their real incomes went up. Now, if that's not bad enough that we live in a forced system where they've designed it intentionally to need inflation and to need inflation to exponentially grow over time, he talks about wages one more time, and he actually says that an increased rise in wages too much is actually bad, because if you have wages start to spike, well, then that translates to too high of costs for companies, and then those companies have to pass on those higher costs to consumers, and then you can get runaway inflation. So he recognizes that we need wages to rise in order for the average person to be able to afford their increased cost of living, but he also recognizes, hey, that's a double-edged sword, because as we do that, those costs are just passed on to consumers. So anybody who gets these raises, they're having to pay it all out in the form of a higher cost of living. Now, the final thing that he says about monetary policy specifically attacking inflation is he admits the long lag time in between when they do something and when the results from that impact the economy. And it's just hilarious. He basically says, hey, if we see inflation is high right now and we do something to attack that inflation right now, well, let's say that's about a year until what we do actually impacts that inflation. Well, what happens if in a year from now, when the results of our monetary policy start hitting the economy, what if inflation has already come back down by that point? Then when our monetary policy results actually start to hit the economy, inflation's too low and we could actually cause massive damage to the economy. And without any critical thinking whatsoever, you might look at that and think, yeah, that's perfectly reasonable. If you're expecting inflation to go back down, you don't want to do any monetary policy right now to counteract that inflation, because by the time your monetary policy actually has a result, inflation might already be back down to, let's say, 2%. That could crush the economy. But here's the problem. When would that ever change? It's impossible to see the future, and everything you've tried to forecast specifically about the inflation rate in the past year, let's say, has been completely off base. You've always been consistently wrong about it. And what makes you think that your forecasts about inflation now are going to come true? And so what happens in 6 months or a year if inflation is not transitory? You can still say a year from now it's going to be lower. We can never enact any monetary policy to counteract inflation because there's such a long lag time. And what if it's temporary? What if it's transitory? You can always say that. You don't have a crystal ball, so you always have the opportunity to say, hey, well, it could be lower in the future, so we can't do anything to counteract it now because then it might have too much of an effect. So it's just an absolutely preposterous excuse to not do anything about the rise in inflation, and it really is just a way to say, hey, we don't really care about inflation right now. We don't want to do anything about it. We'd much rather have the inflation and still get to do as much money printing as we want. Now, specifically regarding their monetary policy, he said, we do expect that by the end of the year, we're going to start tapering our asset purchases. And he said, I want to make it absolutely clear, we're going to take this slow, we're going to take this easy, and we are going to not have this tied whatsoever to any hikes in interest rates. We're going to keep that interest rate pegged near zero. He said that's much more of an aggressive tool. We're going to hold off on that for a while. Now, this is in sharp contrast to all of the statements that Federal Reserve officials have been making for the last week, coming out and saying very strongly, we need to taper, we need to tighten, we need to raise interest rates, we need to start clamping down, inflation is a risk. And it's almost like a coordinated attack where all of these expectations for tightening and hawkish monetary policy have been coming out, blasting the media, getting the markets prepared, getting the markets tightened up, so that when Powell comes out and he says, yeah, we're going to do a little bit of tapering, but really nothing else, now all of a sudden the markets are like, hey, well, that's good news. That's a lot better than what we were expecting, sending the markets to all-time high. And we could see that in gold, we saw that in silver, we saw that in all of cryptocurrencies, but Bitcoin is a big one. We saw that in the stock markets, especially the Russell 2000, up almost 3% today. So markets just loved this news. As to how this will actually affect interest rates, especially considering the federal government is right now trying to pass tons of trillions of dollars worth of spending. They're currently up against the debt ceiling that they haven't resolved. They're spending down the Treasury General account. They've got about $300 billion left in the Treasury General account. So they're still injecting a ton of cash into the system without creating any new collateral for the banking system to offset those liabilities, those deposits of that cash in the banking system. And so it is unclear what this will do, especially to longer term interest rates, especially as the government is prepping to start issuing a ton of new debt right at the same time as the Federal Reserve is going to start lowering its asset purchases, which are, $80 billion a month of those are treasuries. And so a spike in interest rates, especially towards the longer end of the curve, could definitely have an impact on what the Federal Reserve chooses to do about their asset purchases. They may need to either change the composition of those asset purchases or start accumulating more treasuries versus the amount of, let's say, mortgage-backed securities in order to supply the demand that the federal government needs for their debt. So we will see what happens. It is a house of cards. The only question is, what will be the last straw? As always, I really appreciate you guys. Thank you so much for watching. Have a great day.